Hey Shane, how's it going?
Kyle, it is going. I've got the Federal Reserve Chairman Jay Powell in his testimony on my YouTube live right now. So I've got that in my ear in case he says anything worth listening to. I won't hold my breath on that. Um, it's pretty funny, man. These testimonies are such a joke. I've been listening to it all morning and all yesterday morning, and pretty much all it is an opportunity for well, today the Senate is the testimony, so it's an opportunity for senators to like use him as a political puppet. And they did with the way they frame their questions and the questions that they ask. It's like the Democrats are all like, "How awesome is Joe Biden for doing this, that, and the other thing?" And then the Republicans are all like, "How stupid is Joe Biden? And how much of it is his fault that the gas price is what it is?" And it's just like there's just no actionable information. Like it's a giant waste of time. But I don't
Yep.
know. I don't have anything else to watch or listen to, so I got it on. I was trying to watch the Travelers Golf Championship today, but for some reason I can't get it to live stream. So
And that's
watching this
probably
instead.
more important. I was watching it too, and it just seems like it's more questions geared towards how the Federal Reserve is solving for green energy and maybe producing more oil. And, they don't do any of those things. So,
No.
but today is June 23rd for everyone, and it's about 11 a.m. So a little later than normal, and that's Mountain Standard Time. But, here we are. Shane, I've been talking with you about this one, but when we look at the overall market, something I always look at is RSI. And for those who don't know, RSI essentially measures how many consecutive days you have nothing but buyers or how many consecutive days you have essentially nothing but sellers. And the reading down at the 30 level, so we hit that back in January, that's usually what you look for when you pick bottoms. And it kind of tells you that people are just terrified and there are no buyers out there. And we have not hit that level. I mean, all year, just that one time in January. And
Yeah, which wasn't a bottom, by the way. How much are we down from that point?
right, exactly. And you get a
Yeah,
bounce. So here we did get a bounce, but
totally.
that's what you're looking for. But you need a few other things to line up. But it's just interesting the complacency we've seen as a bear market. It just keeps grinding lower. And look at the lines we draw. So we drew this one here that was support, and now it became resistance. This was support prior to low. We broke through. Now it's resistance. Nothing exciting here. I'm not bullish, and we're just gonna, I think, keep trading these levels. The next one would be down into this range, but it's anyone's guess at this point.
Yeah. Hey, by the way, while I'm commenting, you might want to turn on your little spotlight deal so that we can see where your mouse is, because there's a little bit of a lag on these Zoom calls. So um, anyway, yeah, while you're doing that, I mean, yeah. So RSI has not dipped below 30, which is what the market sort of defines as an oversold level since January. And in January, it was not a buying opportunity unless you're a very short-term trader, because ultimately the market bounced for a few days um, and then couldn't hold on to its 200-day moving average before dropping to a new lower low. Then it rallied again back above the 200-day and then has just consecutively made lower lows. There's bounces happen. Market rallied, 9.7% from the recent low to that top green line at like 416.14. So that was like a 9% bounce, almost 10% bounce. And then of course we get the waterfall down to a fresh new low. So yeah, there's just nothing to be bullish about. There's nothing in the Fed commentary that is bullish. There's nothing in this testimony over the past 2 days that has been bullish. I think any bounce you get in the market is just kind of sellers getting worn out. Probably people covering their shorts because they've made money betting against the market. So it's time to kind of bring those in. And then as soon as the market bounces, the sellers come back out again. So I you know, at some point the market will put in a bottom, but I don't think we're anywhere near necessarily that point now. We may be. I don't know. I don't have a crystal ball. I can't like the low we just made. I might hold. That might be it. That might be the low for the bear market. Maybe we'll go sideways for the rest of this year from here, and the market will never make another low. It's totally possible. I don't think it's likely, unfortunately. Because like you said, usually when sentiment really gets washed out, when like the actual buyers are really like totally wiped out and the sellers are done, usually you will see a way oversold level on that RSI, and we have not seen that yet. So any bounce is kind of suspect to me,
Mhm.
and I'm not real interested in chasing the bounces. So I see definitely more downside for the markets as probably more likely than saying that we've already put in a bottom. And is that 339 the pre-COVID high? Is that what that is?
That is.
Yeah.
And so just for reference, from where we stand up to this green line is about a 10% move. And from where we are today down to this line is about a 10% move. So we're kind of, we're tightening it up a little bit. So the next levels of support and resistance, they're a little closer. But like you're saying, at this point, I think that you're more likely to see a sideways market for a while and let some basing occur, or you see that capitulation where it goes, RSI under 30 and just fear in the streets and nobody wants to buy. But I just don't think we've seen that yet.
Can you just zoom it out a little bit so I can see that 339 line connecting to the pre-COVID? Yeah,
Yep.
that's what I wanted to see. Yeah, so
Yeah.
that's
So
where we are. I mean, I think of a revisit to that point. I mean, it just makes a lot of fundamental sense to me because the market and the economy is not in any better shape than it was prior to COVID hitting. In fact, it's probably in worse shape. Um, and so, a drop to 339 over the course of the next couple of months while the Fed continues to tighten just makes a lot of sense to me. So every bounce I see, I think it's an opportunity to sell. Um, and those bounces can last for a couple weeks at a time, and they can go up as much as 10%, and they still don't really mean anything for the long run. I just think it's a process of of going down. So that's what I see in the major index here, the SPY.
yeah. And it's not always all cash. I think so on this personally, just with my retirement account, I have put half of that cash to work down at the lows here, but I will not touch the rest of that until I get a confirmed bottom or a very nice sell off to kind of allocate the rest. Because as most people know, when you're investing long term, getting in down there, not too bad. But you know, we're starting to get to levels that are decent. I'm not going to call a bottom here, but the risk reward long term starts to look a little more attractive.
Yeah, I mean, I looked at some stocks. We're plugging in some new stocks to our Elevate strategies today for the first time in over 2 months. Not because I think the market's done going down, as I just said, but the stocks that we're putting into both our, we bought one in growth and one in value strategies. They're healthcare stocks with great balance sheets, great cash flows, pay dividends. These are some of the best companies in the world, and I'm putting my stop for each of them down below where I think they can drop to, even if the market were to drop, substantially from here. I mean, I'm not necessarily calling for a drop of 50% more or something in the SPY from here, So I don't think those best stocks, the household names that we're buying, they should go down even less than whatever the S&P 500 goes down from here. So I'm not calling a bottom, but I'm also admitting that I don't know what's going to happen, and maybe I'll be wrong. Maybe
Mm-hmm.
maybe we did just see the bottom, right? Like that's the thing about being a portfolio manager, and even if you're managing your own portfolios, you got to know your limitations. I mean, I don't care how much conviction you have, you can still be wrong. I've been wrong lots, and I've learned a lot from being wrong. You probably more than from being right. And so, you just have to hedge, and you have to start working your way into new positions after drops like this. But you don't have to like put all your money back into the market because you think the bottom is in. Even if you thought that the bottom was in, you might be wrong. And so instead of putting 100% of your money or 100% of your current cash balance back into the market at this level, in the long run, it'll probably work out fine, right? But in the short run, it might drop another 10 or 20%. So take 10% of your cash and put it to work. And then, in a couple of weeks, take another 10% of your cash and put it to work. And do the same thing until you're either, getting confirmed that you're correct, or you're finding out that you're definitely wrong, and then adjust your plan from there. But never get into a position you don't know how to get out of, and that includes cash. Never put all your money in cash without a plan for how the heck you're going to get it out of cash, and what is going to be the trigger for you to put some of that cash back to work. So
Absolutely.
definitely something to pay attention to.
And then Shane, I wanted to bring it up a little later after we go through the indexes here, but on the inflation narrative, a lot of the sell-off happened from that. And excuse me, something I want to discuss is commodities. You're starting to see those roll over, and perhaps that's a leading indicator that inflation is starting to step back. But curious if that's what the market's looking for. But we can chat about that a little bit later, and we'll look at a couple of those charts. But why don't we go ahead and flip over to the Qs? How does that sound?
Yeah, that sounds good. I think it looks like they may have just wrapped up the Fed testimony for the day. So I think we're done there. It doesn't look like the market's responding very well to it here intraday. So we're on the lows of the day and falling. So Fed Chair Mr. Powell did not say anything to save the markets. Shocking. Shockingly. So anyway, yeah, I think that just wrapped up, and fine to take a look at the Qs here. So not all that different.
No, it's almost the exact same levels that we're drawing. It's just the Qs went up a little higher before they sold off, so they're moving just a little more, percentage wise.
Yep, the technology stocks are not what you would want to be buying right now. With so many of them dependent on borrowing to increase revenue growth. Borrowing costs are going up. Disposable income is going to go down. Lots of these companies are laying people off, freezing their hiring plans. Yeah, it's not the place to be loaded up right now. We're in quad 4, as we say, and technology stocks are not the best place to be. So I am not real excited about getting super long anything, and least of all probably technology stocks. So.
Absolutely. So now let's look oil. So this is interesting, and I intentionally didn't change the drawings on here. So I'll zoom in. So we had our arrow that we just kept talking about how awesome that was working. And look at this, it broke through the arrow, and you should never draw charts this way, but it illustrates an important concept. And that is, we can be as bullish on oil as we want to be. When it breaks a trend like that, that's where you use your stop, you get out, because look, it's going down. And now I wouldn't be surprised at all if we revisit this green line, and that'd be a wonderful buying opportunity.
Yeah. Yep. Totally agree. Yep, it is breaking down. It has broken down, and if you didn't take profits on the way up and de-risk your position, you're now potentially staring at a loss if you had just bought the original breakout from that yellow line. So doesn't make sense to me to just buy and hold and hope. You got to manage the risk. You got to, when you buy things. Even in the oil market, I mean, oil was the one place to hide all year long. Oil and oil stocks were going up, and they have all started to come down and break those trends. And so you have to have a plan. You have to have your stops in place. You have to follow those stops when they hit, because if you can put a stop in all day, if you don't follow it when it hits, if you stop out of something and you get the alert that says, hey, crude oil closed below 109. And that's where your stop was, for example, in this case, where the 50-day moving average was. If you get that alert and you don't go sell your position, what's the point of having a stop? It's just a feel good thing. It's not actually protecting you if you're not going to follow it like religiously, like every single time. There's no gut instinct. There's no feel. There's no hope or pray or anything like that. When you hit your stop, you get out, and you set a buy alert to get back in. If you like it, in the long run, just set an alert that says, okay, if it gets the same way when you get into a stock or a position, if it falls below your stop, that's where you're willing to admit you were wrong. You do the exact inverse once you stop out. You set a buy alert, say if it goes back above this price, I was wrong and I should buy it back. And that is how the professionals do this year in and year out and stay around for the long haul. So
absolutely. And when you talk about a stop, so I'm going to point out 3 things that I was watching and that are important here. So one, look at the 50-day moving average. So it hit that, bounced a little bit, and sold hard after that. So you've broke a pretty significant level of support. The other thing is we had drawn this line of support, which coincides with that 50-day moving average. And lastly, right here at the top, if you go down, we talked about RSI when it comes to, looking at an oversold condition. Well, here it hit 70 on an overbought condition. So, it was giving some clues that it was a little overdone right here, and breaking that level meant something pretty substantial. So, I don't see this as oil's going to go to 60 and we're going to stop looking at the gas pump and complaining. I think this is just a little breather before it probably picks the trend up again.
Yep, I would agree. I would agree.
So, and now gold, I just
I don't even need to look at this. There's nothing going on there.
Diversification in the portfolio. Other than that, there's nothing here. And then 10 years. So this is pretty interesting. We've had a really strong pullback in rates. So it went up, it broke the level that we'd been highlighting, which was the prior high right there as well. But now it sold back through it, but it's holding the 50. Any thoughts on your end, Shane, as to where this is going to find itself? I don't know, maybe a month or two down the road, or
no, I don't look that far ahead. I mean, I basically expect it to just hang out at the 50-day and then probably resume its rise. I don't see any reason for 10-year rates to fall materially from here. So maybe just a pause and consolidation around the 50-day moving average. Maybe it pulls back further. I don't really know. Predicting interest rates is a tough game right now. It's trending down. So if that 50-day moving average doesn't hold, and again, I can't draw on your chart, but if I could, I would draw some lines and see if they're holding, and and go from there. But no, I don't have any strong feelings about where it'll be in 2 months from now. But I think the trend in rates is not done going higher. I think it's only just beginning.
absolutely. And, I'm the same. I think that it just has to consolidate. Like we mentioned this once before, but look at the separation between the moving averages. It's gotten really wide, so it needs some time to catch up.
Type in mortgage though. Like go look at the mortgage rate, or
Yep.
do you have it on the list?
I've got it right here.
So this is interesting though. I mean, take the moving averages off of that, if you don't mind. Just the eyeball. No, the eyeball. Oh, now you lost it. Yeah, anyway, I don't know. It's almost 6%. So giant spike. I mean, that's all I'm trying to say. Giant spike. You have totally different lines on here than I think I had. So yours just doesn't look like mine.
Yeah,
sorry.
I think on this, and we'd talked about these ranges before, but kind of what I highlighted and have here is we've crossed 6%, and I think 7% is kind of the next level of resistance. But regardless, just not looking good for the housing market. It's going to adjust for anyone that's borrowing. You will not be able to make the same, whatever your payment bought before, it's not going to be the same value of a house now.
Do you mind if I share mine real quick? Because mine just looks a little different. Like I've had the same lines on here for a while, and this is where I had mine. So, we pulled back to this area and then shot up higher, and so now we're on our way back to that 6.81 that I thought we might get to. I think you have your line here, so that's where we're a little bit different. But yeah, the long run, right? The long run trend lines, these red lines, have been materially broken, and we even have a higher low here. So the trend is higher. Mortgage rates are not showing the same behavior as the 10-year rate. Although this is a weekly update, so we haven't seen this update since June 17th, and today is the 23rd. So it'll update again tomorrow, and it'll probably reset a little bit lower than where it is here, just based on what 10-year rates have done. But I don't know exactly what the current mortgage rates are. I just know that this seems to be moving higher, and there's obviously a long ways to go up to the peak at 18.5%. So
Yeah.
I don't think we'll get there anytime soon, but I certainly don't think we're going to go substantially lower. So at this point, that 4.95 level is going to end up being some pretty pretty strong support for rates, and with the Fed continuing to hike, I just don't think there's anywhere for rates to go but up.
And Shane, I was telling you before the call, I was speaking with a mortgage lender 2 days ago, and they were looking to adjust the rates up. And it makes me wonder, because you are seeing it separate a little bit from the 10-year, are they starting to price in a little credit risk? People get nervous looking for layoffs, that type of thing. I'm not an expert on mortgage backs and all that, but it just kind of makes you wonder if that might start to feed in a little bit.
Yeah, definitely. I know if I were at the bank and I wasn't able to immediately sell all my loans to the stock market, and I actually had to hold those loans on the balance sheet of my bank, I would definitely be tightening my credit rules and not just loaning money to anybody who can fog a mirror, so to speak. So yeah, I would definitely be paying attention. Not to mention the layoffs and things like that. Like, just people are getting priced out. People are losing their jobs. People are having to choose between, putting to filling up their gas tank and paying for the Netflix subscription. So when things are that hard, they're certainly not looking to pay almost 6% for a mortgage.
Absolutely. And then I don't know if there's a solution to all these scary pictures by looking at crypto. So what do you got on Bitcoin?
Yeah, well, I can't, I think we updated it last week, but before I was talking about this area and how if it dropped below this purple line here, and I guess I should turn on my little spotlight deal too. But if it had dropped below this purple line, it was going to drop at least 26% down to this red line, and it didn't even hold there. So we're a good bit lower. Bitcoin sitting at 20,000. I think I think maybe it rallies up again into this red line before ultimately making its way down to this 13,800 that we've been talking about for quite some time. That 13,800 number again is a drop of 80% from the highs. And so that has happened many times in Bitcoin's history. So doesn't mean I think Bitcoin's going to zero, but I don't think now is the time to be aggressively buying Bitcoin. I really wouldn't. I wouldn't even look at it until it got back above the 50-day moving average. I think it's a long way off, and we'll see what happens if MicroStrategy, this stock MSTR, they have borrowed a bunch of money to buy Bitcoin. So they borrowed money from a bank to buy billions of dollars worth of Bitcoin. They are already down 86% from their highs, and many have been speculating that they would get a margin call when Bitcoin dropped below 21,000. The CEO, with his laser eyes on Twitter, he came out and said that he had not gotten a margin call yet, and I'm sure he knows where that call is coming. Like, when you borrow a bunch of money from a bank to buy a speculative asset, generally you'll get a few warning phone calls that say, hey, if such and such happens, we're gonna ask you to start selling your crypto to cover that loan that you took from us. So we'll see what that level is. It can't be that much lower. I think probably somewhere in the mid to high teens is where that margin call comes. And the reason that matters is because MicroStrategy owns billions of dollars worth of Bitcoin.
Yeah.
And if they have to sell those billions of dollars in Bitcoin all at once into a market that's already falling, Bitcoin's going to gap materially lower very quickly. And so, that could easily take us down to this 13.8 level. And there's really no reason we can't drop even further than that 13.8 level. I mean, there are lower numbers on the chart, put it that way. So it can go down even more than that. This has been my target since like way back here.
Yeah.
So far, looking pretty good. But there's no telling where that thing could stop. And another company that owns a lot of Bitcoin is the company called Tesla. I think they bought most of their Bitcoin around 30,000. So they're showing a pretty substantial loss. I might be wrong on that. It might have been closer to 40,000. So I think maybe Elon's down like 50% on the Bitcoin he bought with his shareholders' money instead of figuring out how to produce cars for a profit. So that's brilliant, you know, for the smartest man in the universe and the richest man on earth. Nice call, buddy.
Yeah, you know, every asset, that's all it is. It's just an asset. And you guys got to remember that it's Bitcoin, all this talk about how it is going to be the biggest thing ever. Well, look at this chart down 80%. You know, it's not something you want to be putting all your capital into and holding on with laser eyes. And, you know, it's not a winning method.
Yeah. No, hey, when it's going up, it's going up, but you don't want to fight the trend. I believe in Bitcoin in the long run. I really don't. I don't think it's going to go away. I think it's I think it's a global, non-political measuring tool. Like we have global non-political standards of weight. You know, it's the gram, and we have global non-political standards of length, which everywhere but the United States is in the metric system. But you know, there are standards that that you can use to measure things, and they're very relevant, you know, all around the world. And I think that a global non-political standard of value is something that I think the world desperately needs it, because pricing everything in US dollars, to me, you know, as an American, fine. But if I were anywhere else, I would not really like that arrangement very much. And so I like the idea of pricing things in Bitcoin, but this is not, Bitcoin does not represent the stability that it needs to in order for that to come to fruition. So I think in the long run, you know, because no government can just print more Bitcoin into existence, I just think that's a really unique feature, and I think that it will stand the test of time. But we're still in kind of the infancy of crypto, and there will be growing pains, and this is one of them. So thankfully we've been out of this for a long time, and I don't see any reason to be buying it back.
Absolutely. So, well, Shane, I think that's all I had this week. So I don't, unless there's anything else you want to cover, like probably
You
call it.
know, I think that it's worth probably covering, you know, what the Fed's doing, and just you know, maybe even if I go out to our website, and we'll put this in there for anybody who hasn't already gotten it. But in the June 13th market commentary, I sort of discussed well, a number of things, but partly, you know, interest rates are, well, as of this writing, they started with a 0. Since then, the Fed raised, basically doubled the overnight lending rate, which if we go to the Fed funds rate, we can see the recent spike, you know, from here all the way up to here in interest rates. And this hasn't actually updated either. This is like as of May 1. So TradingView is way behind on their Fed funds rate. So the Fed has since hiked from this 75 basis point range up to 1.5% to 1.75%. So it's somewhere in this neighborhood now. And you know, that's what sends mortgage rates higher, and usually the 10-year rate as well. So the 10-year rate that we looked at is interesting. But the point is that we're still, you know, in a historical sense, like even if rates are here, right, at 1.5, call it, we're still so low on the interest rate scale, and the Fed funds rate is that like any tightening that they're doing at this level is not really going to impact inflation immediately. Like hiking from 75 basis points by 75 basis points to a total of 1.5% is not going to change what people are paying at the gas pump. It's not going to change what people are paying for food. It's not directly applicable yet. Like the Fed is still stimulating the economy through easy money policies, even though they're in a tightening cycle. They haven't gotten to what's called the neutral rate yet. They certainly aren't in a restrictive position where they're actually restricting economic activity by raising rates past the neutral level. And so until they get real aggressive, you know, interest rates are not going to have an impact on inflation. We are seeing inflation, I think, beginning to fall and beginning to top, but that's only because of what are called base effects. And so inflation was already pretty high a year ago, and as we get 1 year from those already very high numbers, it's harder to maintain that high number. So rate of change is what's important. And I think the rate of change in inflation was already going to start slowing, whether the Fed was hiking or not. And so now you've got the Fed who's just, they're way behind. They're hiking interest rates, but they're not doing enough. They're tightening into a slowing economy. GDP is expected to be 0%. That's another thing that's actually kind of worth looking at. If you go to GDP now at the Atlanta Fed, you can see right here, latest estimate is 0.0% for the second quarter GDP number, and that's after a negative GDP in the first quarter of this year. So we'll see if the Fed turns out, or the Atlanta Fed turns out to be right in their GDP now estimate. But the economy is not growing, so hiking interest rates into an economy that is not growing on a GDP basis is kind of crazy and can easily cause a crash in asset prices. And another thing that's worth looking at, I shared this with the team the other day, but if you look at the Taylor rule, and you just use their basic inputs for the Taylor rule, which is this fancy formula up here that Kyle and I had to learn and memorize for the CFA program. You can get this heat map of interest rates, and I won't bore you walking you through what all the different quadrants of this are. Quadrants probably isn't the right word because there's more than 4, but this matrix, all you need to see is that the lowest rate on this thing is 4.88, and we're currently sitting at 1.5. They are nowhere near where they need to be in order to get inflation under control. It's not even close, and they're not going to get close anytime soon. So all the inflation slowing that you see, as you begin to see it, right, whether it's oil coming down in price materially over the past couple of weeks, or if the food prices begin to drop, or used car prices begin to fall, it has nothing to do with the Fed yet. They need to get rates way higher, way faster before they're the ones actually impacting it. So they'll probably try and take credit for it no matter what happens. They'll say, oh, inflation slowed down because we started hiking interest rates, and it won't be true then. Just like they called inflation transitory right up until it was way too late to do anything about it. So you can't put a lot of faith in these guys. They're nowhere near where they need to be, and they probably never will get there. I mean, they're always behind because they're data dependent. They're always looking through the rear view mirror instead of out the windshield. And what they ought to do is just get the heck out of the market. That's what I wish that we could go back to 1913 and abort the Federal Reserve before it came into existence. And yes, there would be recessions and contractions, and people would still lose their jobs from time to time. But I think all the cycles would be way less magnified, and we wouldn't get so much waste and misallocation of capital during the bull runs and the boom time. So, it's just one thing I thought it would be interesting to kind of point out, is that the Fed is not responsible for any slowing of inflation that we're seeing yet. In fact, they're responsible for lighting the inflation fire and then fanning it and then pouring gas on it, and they're nowhere near hosing it down yet. So
absolutely. And it's always interesting too, just the Fed, they seemingly have this crystal ball, but they look at CPI, which is a lagging indicator. Meanwhile, commodities start rolling over, and that's a little more of a leading indicator. And it makes you just wonder, if we do see prices come back down where they should be, I mean, look how slow they were with identifying that inflation happened, even though houses and everything else is going up. And if they're just behind the curve and just keep hiking into a slowing economy, it's gonna be a fun train wreck. Well, not so fun, but I guess fun to watch, but not liking the results of that.
No, I mean, as you said, commodities are getting crushed. Freeport McMoran's one I've been watching for a couple of days now. This thing's down 43% since the end of March. Big copper producer, and I mean, this thing is it just looks awful. And I think there's a lot of other commodity names that aren't looking very good either. So you had speculated earlier that the slowing commodity prices might help inflation start to roll over. I can assure you there's nothing to do with the Fed. when it comes to that. This is just
Absolutely.
normal base effects of markets. So anyway, I know we've gone a little longer than we planned on, and we got a late start, so we probably got to get running. But the ultimate conclusion is there's just really nothing to be bullish about out there. Market might bounce, it might rally. Until we get to a point where we're consistently making higher highs and the markets trade back above their 200-day moving averages, there's really nothing to get excited about. And for us at Elevate, you know, and in my personal accounts, I'm not looking to get aggressively long anything until the Federal Reserve backs off of their current hawkish stance, until they say, okay, we're going to stop raising interest rates for now, and we're going to maybe even stimulate the economy. Now, just to be very clear, I don't like that that's what I think. I wish they would stay out of it. I wish they wouldn't have anything to do with markets and just let markets do their own thing and go where they go, and that's it. But unfortunately, that's not the world we live in. So the Fed stepping away from their hawkishness, stop not selling assets into the market, not hiking interest rates, maybe even reducing interest rates, maybe even buying bonds again, maybe even buying stocks again. When we start to get that type of messaging, that's when we'll want to get aggressively long stocks again. But we are way long way from that happening. Probably not going to happen this year. So unless the market drops really hard, really fast, then that might change their tune more quickly. But for right now, the Fed has told us that they're determined to get inflation under control, which means hiking interest rates at the meeting in July, hiking interest rates again at the meeting in September, and probably again after that. So no reason to get bullish.
Absolutely. So awesome. Well, Shane, thanks again for your time, and we'll see you again next Thursday.
All right, later, Kyle. Thanks.
Yep. See ya.